Let me ask you about your expectations for equity returns. Given what we're expecting now from the Fed, given how fast our expectations of the Fed are changing and shifting, and the market is having to price in higher interest rates a little bit sooner, what does that do to your expectations for equity returns, and how do you position appropriately?
Good morning. Yes. So, look, I've been on the show a lot, and I've been pretty optimistic from the lows, simply because the Fed was going to be ultra accommodative. And as the central banks begin to move off that accommodative pivot, it means that equity returns are still going to be positive, but they're going to be lower. And in that environment, I simply think that it requires a little bit more of a balance between risk on stocks and risk off stocks, i.e. controlling, kind of the beta of your portfolio. And so we've just had this extreme risk off move. Yes, the market is only down 3%, but staples are up 8%, and financials, energies are down on the month. And so you've had an extreme move, and I think that's going to be the story going forward, more so than it's really been since the lows of March of 2020, which has really been a period of risk on. And so I think it's just simply going to require a little bit more of a balanced portfolio. But what I wouldn't do right now is I would not chase the defensive risk off stocks. They've just had a very big move on a relative basis. And I think that's going to be the story over the next year, which is you're going to have these periods of big risk off, and then the market's going to come roaring back. So I think you can take advantage of it. And in this environment, you have to start to scratch your head and say, gee, maybe I should be looking around some of these banks or energy stocks or small caps that are down a lot, and then waiting for a better period to add to defenses if, in fact, you're underweight there. And that's, that's really hurt you the last 3 weeks, but I wouldn't chase them here.
Andrew, you say you're not getting bearish, you're just getting less bullish. Can we dig into the nuances of that and provide some definitions? What is the difference between a bearish outlook and a decreasingly bullish one?
Sure. So what you see is obviously the first year off the low, like we had in last 2020, you have a very strong market because the Fed's just pouring money in. And the second year, which is this year, the market continues. It happens every time because you have a combination of big earnings recovering by corporate fundamentals and the central banks pumping liquidity. It is typically in the third year that we're going into where returns remain positive, but they're not as strong because you have kind of a battle between still good corporate fundamentals, and I think that's going to be the story next year, but you don't get the PE expansion, you don't get the liquidity pump from the Fed. So the result is a little bit more of a, the Fed tends to throw cold water on kind of strong corporate fundamentals. Look what's going on today.
Yeah.
We got more companies reporting great earnings, but you don't have that further injection coming from the Fed. And the result is positive returns for equities in the third year, which would be 2020, just not as good as you've seen in the past. I think it's way too early to get bearish, to think the market's going down, because corporate fundamentals are going to continue to come in strong. It's just not as good as what we've seen off the low.